This video is supported by CuriosityStream. Get access to my streaming video service Nebula, a Streamy Award-nominated service when you sign up for CuriosityStream at the link down below. With inflation peaking at 8.6% in June 2022, the risk of another recession is high. Some, like Elon Musk at a conference in May, argue that we are already in a recession, while others, like banks and the United States government, have only warned about it. President Biden tries to convince people that high inflation, supply chain crunches, and the skyrocketed gas prices are caused by the Russian-Ukraine conflict, but most of us know that our economy is not good even before that. For the first time in 40 years, the US has now two sad records. Its GDP is growing slower than that of China, and an 8.6% inflation peak this time is also the highest rate we've seen in the last 4 decades. A year-to-year percentage change in the consumer price index measured a jump of 8.6% in June, and if we take the core inflation out, such as cost for gas and groceries, the number is still at 6%. The Feds aim at 2% annual inflation on average. However, the inflation index peaked at about 6.6% over the year through March. The Fed has said it will do everything it takes to bring down inflation, which could mean higher interest rates. With the continuing lockdowns in China and the war in Ukraine threatening to worsen the global supply chain for important products such as semiconductor chips and commodities, some have predicted that the next recession will occur in 2023. It is without a doubt that the Great Recession from December 2007 to June 2009 may have been one of the worst one yet. It led to millions of Americans losing their homes and livelihoods, but the one we all seems to be handling into 2023 will be vastly different. So what is different this time? First off, it's worth mentioning that recessions are a normal part of business cycles. A recession is defined as a contraction in economic growth lasting 2 quarters or more as measured by gross domestic product. According to a senior partner from Wealth Advisors in Savannah, Georgia, this time round, corporate America has never had more cash on its balance sheets. Bank surveys show that consumer is not overladen with consumer debt, and there is a lot of cash in people's checking account, so there seems to be a fair amount of spending power. The common denominator for recession is widespread job losses and terrible hardships for people. Not every recession is the same. There are typically 2 types of recessions. The first type is called balance sheet recession, which happened in the Great Recession. This is when a debt bubble emerges, causing consumers to spend a significant amount of their income to pay off debt instead of spurring economic activity. They no longer purchase stuff, and companies crumble, which leads to slower recovery and massive unemployment. The second type is called garden variety. This is when the economic overheats, causing inflation to rise. Many fingers point to President Biden's $1.9 trillion spending package and the American Rescue Plan overheating an economy that was already running hot. This is most likely the type of recession that we're entering. Doing too much rather than doing too little. Let's break it down a bit. The US experienced a short-lived COVID-induced downturn for 2 months from March to April 2020, when unemployment went from 3.5% to 14.8%. On February 5, 2021, President Biden emphasized the risk of insufficient stimulus. He argued that the US economy faces a more prominent threat from doing too little to fight the economic downturn. His administration has been pushing for a large stimulus plan to reduce unemployment and grow the economy.
Look, just this week, the Congressional Budget Office projected that if we don't take action, it would take until the year 2025 to return to full employment. If we make these investments now, with interest rates at historic lows, we'll generate more growth, higher incomes, a stronger economy, and our nation's finances will be in a stronger position as well. So, the way I see it, the biggest risk is not going too big. If we go too small.
At the time, the risk of inflation rising seems not to be a problem. Federal Reserve's Chair Jerome Powell told the Senate Banking Committee, "I really do not expect we will be in a situation when inflation rises to troublesome levels." On March 11th, Biden signed the $1.9 trillion economic relief plan. The plan pumped billions of dollars in new stimulus checks, state aid, and extended unemployment benefits. He hoped to support the country's backbone, such as the working class and middle class people, in times of struggle. At the time, Treasury Secretary Yellen told ABC that there's a small risk of inflation, but not a significant one.
Prices fell a lot last spring when the pandemic surged. I expect some of those prices to move up again as the economy recovers this spring and summer. But that's a temporary movement in prices. To get a sustained high inflation like we had in the 1970s, I absolutely don't expect that. We've had very well-anchored inflation expectations and a Federal Reserve that's learned about how to manage inflation. So I don't think it's a significant risk, and if it materializes, we'll certainly monitor for it, but we have tools to address it.
In June 2021, the first inflation sign emerged, and Yellen acknowledged for the first time that inflation could wind up running higher than expected. The Fed on June 16th revised its forecast for inflation, predicting a 3.4% rate for late 2021. Fast forward November 2021, when the Bureau of Labor Statistics issued their revised estimation for job growth in Q1 2021 to September, it became clear that the government's initial reports on employment have been consistently reporting underestimated numbers. What looked like a slower recovery economy turned out to be a sizzling hot one. The realization of a soaring job market came with the realization that inflation was indeed also soaring. At the point, inflation spiked up to 6.2%. In February 2022, the Russian-Ukraine situation emerged. Western government imposed a number of sanctions aimed at crippling Russia's economy. However, the fallout of the war affects America severely, sending food and energy prices to the roof. In May 2022, the Fed raised the interest rate by 0.5 percentage point for the first time in 4 years. Inflation is much too high, said Powell. Despite the worries about another recession, some remain positive about the numbers. The unemployment rate is historically low at 3.6%, for example. Job growth remains strong, and consumer spending is steadily rising amid inflation. Still, some continue to sound the alarm because of other indicators. Firstly, the personal savings rate fell to 4.4% in April, the lowest since September 2008. According to research by St. Louis Federal Reserve, the average personal savings rate from 1959 to 2019 was 11.8%. Secondly, the Federal Reserve is set to continue raising interest rates until there is a clear and convincing evidence that inflation is under control. Thirdly, some bulls have recently changed their tune regarding the potential for an economic downturn. Mark UBS Global Wealth Management's chief investment officer, has for months brushed off fears of a recession, noting in a May 17 note as a US recession will be avoided over the next 12 months. However, in another article on LinkedIn in May 27th, he wrote, "The path to achieving this, successfully bringing down inflation, is narrow. If Fed policymakers underestimate the strength of the United States economy, we face an extended period of above target inflation. If they overestimate it, we face a recession, and we can't know with great conviction which path we're on." While recession may be inevitable, it is a normal cycle of economic activities. Perhaps the best thing we can do for ourselves now is to educate ourselves on the basics of economy and how this world works. If you want to see more content like this, you should check out my streaming service, Nebula. Nebula is my go-to streaming service built and owned by creators like myself, Tech Arta, Real Engineering, Polymatter, and many others. It's a platform without ads, so you just watch stuff you want without any interruptions, and it allows us creators to make good content for you. Nebula includes hour-long, high-quality documentaries from your favorite creators on YouTube. And because CuriosityStream likes to support independent creators, Nebula has teamed up with CuriosityStream, and you can get Nebula for free when you sign up for CuriosityStream with a link in the description down below. If you haven't heard about CuriosityStream yet, it's a platform that has a huge collection of big-budget, non-fiction videos. Knowing that the value of US dollar is heavily reliant on the central government, the Federal Reserve, a new emerging currency, has been on the horizon for more than a decade. It is no other than cryptocurrency. However, as cryptocurrency is a decentralized currency, there's there's no body of government to govern it, which leads to a lot of uncertainty and trust issues. Check out the series Blockchain Revolution on CuriosityStream to learn more about the subject. Most importantly, the series might provide the answer as to why cryptocurrency like Bitcoin can be trusted to help manage everything in our day-to-day lives. Go to curiositystream.com/curiouselephant to get a full year of access for less than $15 today.